we're going to talk about some more indicators, some moving average crossovers, how we can use some of these indicators to help us make better decisions from the technical standpoint. Of course, you always have to do your research. Do not rely on technical indicators alone. If you can possibly combine it with fundamental analysis, and as we do here in the Dorian Way, we're quantitative toward options and deltas. The idea is to combine it all together to just put forth a nice trading plan. So technical analysis part 2. Again, as I was saying, let's do a little recap of what the material we covered on the previous lesson, which was the very basics. The first point is the trend. Remember that prices trend. That is a fact, and it's a theory that has been in place for many years. Prices trend one way or the other, and us as technical analysts, our way is to try to identify the trend as early as possible so that we can trade with it, and we can pretty much ride it until we can't do it anymore. That's how the bigger trades are made on a daily basis by funds, by the bigger players out there, but also retail traders like us. We also discussed the importance of volume in a security. So how many shares are being exchanged, how many shares are being bought and sold for a specific security. It's very important because it allows us to know the actual interest on the security by all the traders out there. Okay. We also discussed support and resistance level, how to spot support and resistance, and on a chart on different time periods, which is very important. We also discussed the types of charts. Okay, remember we've got the line charts, the bar charts, and the candlestick charts, and we focused more on the candlesticks because it's more widely used by all the players in the market. And with that, we also discussed the components of a candlestick, right? What is the real body? What is the upper wick and the lower wick mean? What is a green candle versus a red candle, and so forth. And lastly, we discussed the moving averages, right? The two most widely used moving averages, the simple moving average and the exponential moving average, how they're calculated, and how can they help us identify the direction of the trend. Okay. So now for this presentation, we're going to talk about the first point. It's going to be moving average crossovers, and then this is expanding on the very last section of last presentation about moving averages. Okay, so let's kick it off. What is a moving average crossover? So a moving average crossover occurs when a faster moving average, for example, a shorter period moving average, crosses a slower moving average, i.e. a longer period moving average, and it signifies a potential change in momentum. Okay, what is the importance of it? Well, the premise is that this technique can help us identify an early change of direction, thus allowing you to trade accordingly. If you're a directional trader, and then you spot a moving average crossovers, well, you can do, now it's decision time, right? You can play directionally through options or through the equity itself. You can sell options as well. That's one way to play directionally. But let's actually take a look at the chart and see what we actually mean by a moving average crossover. So what I've got here is the one year chart, 1 year, 1 day chart of Apple computers, right? And what I've got is the simplest form of chart that you can have with two moving average. Okay, this blue line that you see is actually an exponentially smooth moving average of a 20 period, so 20 periods. And the red line is actually a 50 period simple moving average. And we can see that here at the top. It's color coded, so you know what they all mean. And each little bar here or candlestick represents 1 day, 1 day's worth of activity in the stock. So a moving average crossover occurs in instances such as right here and here, also right over here and over here. As you see, depending on the moving averages that you plot, and the trend, it will not occur very often when market is trending, but it will occur multiple times in a trendless market, a market that's fairly flat or with no direction. So if we go back to our definition, so what does that mean, a faster and a slower moving average? Well, here, the faster one is the one with the shorter duration. In this case, the 20-period moving average is going to react faster to changes in price. The longer period moving average is going to react much slower, but it's going to give us a better signal when the time comes for actually addressing the main trend. So in this case, the shorter period moving average, the 20, when it crosses below the slower, we can deduct that this may be a bearish signal. Okay, and we can see that here when the crossover happened, okay, it wasn't a down day, which Apple recouped some of the losses. It went up for the next couple of days, but actually ended up just falling. If we see here in the graph for the next couple weeks, maybe 2 weeks after that, it wasn't a mini downtrend. But I guess the importance of this is that you also need to combine it with other points of view. Now, when we see another crossover is right here, where now the momentum is shifting towards a bullish momentum, and we see now the slower crossing above the slower moving average, indicating that there may be a shift in momentum from either a sideways trend to a bullish trend. And we see that indeed it was a very nice signal to get into Apple right at this price point of $69 in late April, and we see that Apple hasn't turned back ever since. As the trend continues, we can also see that the price is bouncing off of this 20-period EMA, but never actually breaches it until right up at this point, which was a sort of fraudulent signal because it bounced right back up and it continued its way up. So we can deduct that, let's say that you see this crossover and there's a potential signal for going long, and let's say that you actually place a trade to go long, you can safely say that you can maintain this long position until there is another crossover, okay, or until the price is not right in the averages anymore. Okay, so this is just one component of the studies that we do here. Now let's go to our following indicator, which is the average directional movement index. Now this is also one that I personally use, and it's very interesting. I don't know if many people use it. I'm sure a ton of people use it, especially those that are trend following. They have trend following strategies and things of that nature. But let's take a closer look at what actually the ADX is. Okay, so the ADX is a line that indicates an increasing tendency to trend in a corresponding direction, whether it is up or down. Okay, and what is its importance? Well, its importance is that it is a great tool that allows us to identify the strength of the trend in any given period. This is key right here, guys. The strength of the trend. This is the only thing that the ADX is very nice in helping us identify. And what do I mean by that? Okay, let's jump back to the actual same chart and let's plot the study. So this is, by the way, I'm using Thinkorswim, which is the proprietary platform of TD Ameritrade. It's very powerful for charting. It allows us to plot many studies. So I'm just going to my little vial here, and let's plot here ADX. It's the first one that pops up. Okay, and we just apply it and okay. And here's how it looks. Okay, it's a simple line that oscillates between a higher value and then a lower value. Now, keep in mind that the ADX is always going to be a positive value. There's no such thing as a negative ADX. But again, it helps us measure the actual strength of the trend. So if we are on when you see the ADX that is actually moving upwards, what it means is the trend is moving upwards, okay? Whether, I'm sorry, in this case, the trend was moving upwards, but if the trend is actually also dropping, we can see an uptick on the ADX as well. So in other words, the ADX is going to increase when we see a very strong trend or a lot of momentum on the trend. The ADX is going to let us know that the trend, whether it is up or down, it has a lot of strength. When we see the ADX now coming down a little bit, it's because we're entering a little dull or directionless market. That the trend is not really clear, right? It's just bouncing off of some channels that's really not letting us know. Keep in mind that when you see the most usefulness of the ADX is when we have a period where the indicator is actually low, because this is usually preceded by a uptick, or eventually this is going to go up when the trends go to pick up momentum. Let's take a look at some other tickers, such as the cruise liners, right? We all know that the cruise liners got hit pretty hard when COVID happened, because they all got shut down. Most of them are not even US based. So there was a lot of speculation whether they were going to keep in business or they were just going to shut down. So they got hurt really, really bad, as you can see. So this is the drop, back from February to March. But as we see that this downtrend picks up momentum, we can confirm it here with the ADX that, as a matter of fact, the trend is, it has a lot of strength. When we see the ADX going down, we start to see a somewhat of a choppy market. It goes sideways for several months. Maybe it picks up here a little bit, and we can confirm this by this uptick on the ADX. But then for the most part, it just keeps going sideways for the next several months, and then we see not much activity here. When and if there's good news about the cruise liners, whenever everybody is vaccinated, everybody starts to pick up those tickets and start traveling like crazy, we will see, you see that the ADX is now at the lower spectrum of the value. We will see an uptick on this, and therefore that should confirm, if the cruise liners ever recover in such a manner or the same way that they dropped, we are going to see that bounce. Okay, so this is also one of my favorite indicators. And by the way, guys, this is feel free to interrupt me and ask me any questions while I'm doing this. Okay?
Wondering, hi Gustavo, this is Steve. So wondering if this is a lagging indicator, because I see that the up happens after the stock moves, or is
yes.
it
Yes, sir. So this is a lagging indicators. It's a lagging indicator just as the moving averages, right? The matter of the fact is that this will tell us only after the fact, but there's still time to catch. Remember, when you're trading, the goal is to, if you're directional, to catch sort of like the meat of the move. You don't want to try to pick tops or bottoms, because it could be very dangerous. But as long as you catch the meat of the move, you can potentially profit for that, right? So this again allows us to identify it after the fact, but still be able to catch some of the move when its magnitude is exacerbated, like just as this drop. But it would also help us to sort of position ourselves into, I don't want to say predicting, but that after a period of a lower value in the ADX, it's got to pick up somewhere. Whether this rips to the upside or just keeps crashing, this is going to keep momentum, and that's where you wanna place your bet on. You wanna place your bet on this thing going higher, so you can kind of catch this on.
So, so is there significance for that number, like 10 to 70, and is there any number that we need to look to measure the momentum or something?
Not really. No, there's not much significance. This is just the strength of the trend. So the higher the number is, it just means that the trend is really, really strong. So when a trend is really, really strong, you do not want to bet against it. Remember, the trend is your friend. So if you were trying to pick bottoms here, you would have gotten crushed. Same thing with something like Amazon, right? So see, as the ADX moves towards the upper values, we see a strong uptrend. So if you're trying to short Amazon, most times than not, you're gonna lose money. So the thing is, when the ADX is high, do not try to place bet against the trend, because most times than not, you're gonna get burned. Unless you're really experienced at this, you do really short trace that you profit and then you're out, right? You take your money and leave, but not trying to like do a huge short trade or long trade when a stock is crashing in this way.
Thanks.
Perfect. Oh, absolutely, guys. Thank you for the question. So let's move on. Now let's move on into oscillators. Oscillators are a big part of technical analysis. But what is an oscillator in the first place? Well, oscillator is a technical analysis tool that constructs high and low bands between two extreme values and fluctuate within these bounds. Okay, the three of the most popular oscillators utilized today are the RSI, the MACD, and the stochastics. Now, the stochastics is a little bit more complicated, and we're not going to get into that into this specific presentations. We might get into that into future series of this technical analysis part, because stochastics has a lot of ramifications, right? It has a fast stochastics, slow stochastics. It's somewhat complex, okay? But the RSI and the MACD are very somewhat straightforward, so we're just going to focus on those two, okay? So the first one we're going to focus on is the relative strength index, or the RSI. So what is the RSI oscillator? It is a momentum indicator that measures the magnitude of recent price changes to evaluate overbought and oversold conditions in the price of a stock. How can we interpret it? Well, the RSI is a line graph that moves between two extremes. It's usually 0 and 100, okay? And generally, anything over 70 is considered overbought area, and anything under 30 is considered oversold. Let's actually take a look at an actual example here of the RSI. Let's go back to Apple, and let's go back to our studies. Let's clear this ADX study, and let's just plot the RSI. And by the way, these just some context, right? This RSI was developed by the same guy who developed the ADX. His name was Will Wilders. He developed many indicators, I guess, upwards of 10 indicators that are really useful and used today. And he was using some sort of the same logic to a lot of these indicators, okay? So we see the RSI, the first and foremost, an RSI studies, the most common is 14 periods, okay? And you see that by this little number. This is the most commonly used. You can use in more periods, but the standard in the industry is 14 periods. And also, do not confuse this the relative strength as if you were comparing this stock to any other stock or any other benchmark. There is another indicator which I'm going to discuss at the end of the presentation, which is called the relative strength indicator. This is the relative strength index, two different things, because the relative strength index, the RSI, it's the stock against its same price action, okay? It does not compare itself to other stocks or other benchmarks. It pretty much evaluates in the past 14 days the amount of up days and the amount of down days, okay? And it converges it into this oscillator. So essentially 0, it means that the stock had no up days. So pretty much it was just dropping day by day. And a reading of 100 is the stock has only gone up and up and up without even dropping a little bit.
Gustavo?
Yes.
You were describing the index or the indicator just now?
Right now it's the oscillator, the oscillator, okay? Which is the index, right? The other one is the indicator. I know it may be a little bit confusing, but we're just going to recap it at the end, okay? So this is the RSI oscillator, which it only studies the stock itself, okay?
Thanks.
Is the other one the IBD relative strength indicator you're talking about?
Pardon me?
Is that the IBD investors business relative strength which compares to the market? Is that what the other one is?
The other one, well, I'm going to get to that. The other one is just how you compare a security against another security, or to see its performance, or a security against a benchmark. For instance, the SPX or the NDX, the NASDAQ 100, how you compare the one security's performance against another one. But again, this one is just different. It's comparing the same prices of the stock and see where they land, okay?
Yeah, can you clarify again what are both called? I just got confused. What's the name difference between these two? Relative strength index and
it's just the last. Perfect. So this one is called the relative strength index, and let me just show you here. This is the relative strength index, or the RSI. The other one that I was talking about, which we're going to get later, is the relative strength indicator. Okay, so I guess the difference is just on that last word, index, and the other is just the indicator, or the relative strength line. Okay.
Thanks.
Yeah, absolutely. So as you can see, it oscillates, right? And the lines are plotted for you. The overbought and the oversold are plotted on these yellow lines. So again, this is just a yearly chart of Apple, and we see that at the beginning of the year, Apple was trading on the overbought zone for a little while until it didn't. But the actual key takeaway is that depending on the time frame, by the way, you can use this on a 10-minute time frame. You can use this on a hourly time frame. You can use this on any time frame you want. Now, keep the relevance of this indicator becomes more solid the more periods you actually go out. So if you go out a year, the signals are going to be more meaningful than if you were doing a 1-minute chart, because the fluctuations, of course, are going to be less. You can see that in the past year, the only instance in which the indicator breached the lower band of oversold was, right around, late February, early March, where prices started to drop a little bit. And you see that it picked up right away, and it hasn't gone back ever since. Now, Apple has been into the overbought zone multiple times within the last year. We see one instance here at the beginning of 2020. Then somewhat mid-year, we've seen a lot of instances. And this is where really understanding how the mechanics of the market and the trend will help you really have a good reading on this, okay? Because the fact that a stock enters into the overbought zone doesn't necessarily mean that you need to play the contrarian right away. A lot of people just play the contrarian on this. Okay, if it breaches this level, I'm shorting the stock because eventually it's going to drop back down. And that is true up to a certain degree, because when we have a strong trend, the stock can remain on this overbought zone for an elongated period of time. So let's take this example here, okay, in which from first week of August here up until the first week of September, Apple was on this overbought zone. And it went up here, and it sort of came down, but it was a little bit fraudulent, and it stayed there for pretty much a month. So let's say on this day that Apple gapped up and you see an overbought reading. And if you're just a contrarian and you don't look at any other indicators, you don't look at any other context, you don't see that there's a pretty strong trend. Your first instinct would be to short the stock or buy some puts or pretty much play against any long positions. But see what happens. So the momentum starts to pick up. Apple goes and flies from 105 pretty much all the way up to like almost 140, and you see that the readings kept on the overbought zone. But if you would have bought puts, you would have lost money. If you would have shorted the stock, you would have gotten crushed. Just playing that contrarian. And the premise is on strong trends, be very careful trying to play contrarian because you may get hurt. Okay, you just want to wait for the first indication that the line breaches below 70 before ideally you can place your directional move, or you can see some other signals that signal on exhaustion on the price action. For example, here, of course, with the benefit of hindsight, right? Everything seems, very evident. But when we're, right at the moment of trading, you never know when this is going to end. But there are, if you had some moving averages, yes. Oh, sorry, I thought I heard someone. So of course, with the benefit of hindsight, everything seems so evident. But you want to put this study together with maybe a breach of the EMA and the simple moving average to then place a short position or puts, right? So in this case, if you see that the RSI is dropping that overbought or is in that overbought zone, and you see Apple dropping and maybe breaching at first instance this 20 period moving average, which hasn't breached it since this instance, well, you can think of yourself, okay, so now I've got two things that are telling me that there may be an exhaustion in this move, so I can maybe just play the short side for a little while, for a little bit, always keeping your risk limited, right? And same thing we can evaluate with other securities such as Amazon, right? So if you see Amazon has not entered into that zone in the last year, it was very close, but then it reversed back. Again, it has been on that overbought more times than not because it is a very strong stock. Things like Nvidia, right? Stocks that have done really well during the pandemic. Pretty much all the FANG stocks have done really well during the pandemic. And then if you would have taken this signal back in March when there was that overreaction in the market, you would have made some nice money there. Okay. So yeah, let's move on then on the RSI. So pretty much all you want to play is the you want to watch those levels when it's oversold and the stock is its strength is relatively, especially if it's a blue chip stock, and if you see solid fundamentals, it's just maybe an overreaction for a macro event, and you get this reading of oversold, maybe you start to pick up some, right? You start a position, whether it is in options or equity, and then you get your feet wet. And then if it doesn't work, well, you adjust. Remember, you always have to have your stops, always have to manage your risk. That's what it's going to keep you in the game for a long time.
Gustavo, I got a quick question for you.
Yeah.
Go back to Facebook or Apple.
Yeah.
So in both those cases, go to Apple. It feels more relevant, the RSI indicator. Mm-hmm. It feels like it's right in the middle of the channels. Both of them do. So if you're trying to read the tea leaves going forward, and does that potentially mean to you that it's a good time for an iron condor to make a little money on both sides because it's in the middle of the channel? Its relative strength RSI is not up in the upper bounds, or it's not in the lower bounds. Is that another way of looking at this, absent any other data points?
Absolutely, Ernie. It is a way to play it. When it's within the bounds, you also have to look at what way is it leaning towards, right? Let's say in this case Facebook is leaning towards the it's not quite there yet, but it's leaning towards the oversold condition. And whenever a security, again, it's on the oversold, it means that more sooner than later it's going to pick right back up. And so if you're going to place an iron condor, maybe you look at to place a skewed iron condor in which you don't play or your call side is actually not as tight as the put side. You can leave it a lot more room to the upside, because you know that if it keeps reaching this level and then it goes the other way, your call side on the iron condor may get compromised faster than the put side. So you absolutely can. I would just skew it up a little bit depending on the risk reward in this scenario.
Cool, thank you.
Gustavo?
Yes.
Gustavo?
Okay.
The on the bottom, the horizontal lines for 30 and 70, are the software put those lines there?
Yes, everything is automated by the
Okay.
software. And again, the readings of 70 and 30 are pretty standard, but you could also, more people with more expertise, they skew them up a little bit depending on the situation. Some of them will skew it up to, will bump this up to 80, and the 30 would bump it to 40, right? Depending on the macro conditions and so on and so forth. But I would say the vast majority of software, trading softwares, are going to have the standard of 70 and 30 with a 14-period RSI.
Gustavo, quick question. Okay, so I'm looking at the very last candle there. And so I'm seeing a crossover. I'm seeing that the candles are below the moving average, and I'm seeing a downtrending RSI. So would you then make the prediction that this would be a good candidate to do a call vertical on it, that it's going to continue going down?
That is a great craze, Devel. It everything as far as we can see tells us that well, this may be a candidate for a call spread. I would go a little bit far away, but remember that the crossovers, the moving averages, and also the RSIs work better on trending markets. We also have to take the context of the last couple of months in Facebook. There's not much of a trend here. We could argue that this is mostly a sideways move. It's not like this move where the clear uptrend it's there. This is mostly a sideways, now leaning towards the downside. So this is the danger with trying to do or play crossovers on directionless markets, or not. I wouldn't say directionless, but I wouldn't say without the presence of a strong trend. Because yes, while these readings are telling us that, hey, maybe this is a good candidate to play a call spread, or maybe just play directionally some puts, the risk reward is not as skewed to your favor. Maybe this is a 2-to-1 or 3-to-1, but you always want to find those outsized opportunities where the risk reward, where you're risking, I don't know, $2 to make $8, or where you're risking $5 to make $20, not risking 1-to-1, because mathematically you want to have those odds in your favor to be able to to last. But yeah, I would be careful on this scenario, because again, it's somewhat of a sideways market. Yes, there's a crossover, but look at what happened here, right? There was a crossover here, didn't mean much. There was another one here, maybe it meant a little bit here when this gapped up, but it's really tight. Okay, I'm just going to keep an eye on that.
Gustavo, just to what you had said earlier, these indicators are really just to have us like, okay, wait a minute, now the market might be doing this. We're not trying to time it, but then when we do see an up move, then we'll jump in on a trade or something like that. Like you said, the meat of it. Is that?
And again, on the RSI, the best opportunity, if you're playing directionally, it's going to be when the line breaches any of this two lines, because yeah, technically you could place a trade here with this reading here leaning towards the oversold, but it's not quite there yet, and it doesn't really actually do the threshold. And by not entering the threshold, the risk reward is not as pretty as if you were down here and maybe this crossover is a little bit more elongated, where this is starting to curl. Then you can say, okay, now the odds are stacked more in my favor than previously, therefore the probabilities of it working, it's greater.
And just this is also, why do you put certain numbers in on the moving average? Like I'll have the 50 and the 200 because I was told just use that because that's what the big institutions use. I did at one time I had 20, 50, and 200. Oh yeah, I think those were the three. Can you explain why you chose the moving average numbers as you did?
Yeah, it is pretty subjective. Although there's not really a hard set rule, but it is a thing that experienced traders know which averages are the most used, right? So as you said, the 200 simple moving average is used by a lot of big hedge funds, institutions, and that just represents like a very important level, whether it is on downside or the upside. But then again, things that are more common are are moving averages such as the 13-week, the 20-week, or period, I should say, 13, 20. Some people use the 30, 50, and then the 200. Now you could plot any period that you want, right? If you wanna see fluctuations, how does the price fluctuates, right, on different periods. But it just comes down to, and maybe O'Brien can correct me on this, but it just comes down to with experience, you tend to know which are the most widely used. And the importance of it is, the more people are looking at the same moving averages, you can expect the same sort of behavior on people when they are looking at the same averages, if that makes sense.
That's perfect, Gustavo, and I agree.
Awesome. Yeah. If that answers your question, Nora.
I would also add, Gustavo, that for whatever indicators or moving averages each individual decides to use, whether it's the 50 and the 200, the 20, the 30, using them consistently is going to give you a better feel for the market than going back and forth from using this month I'll use the 30, next month I'll use the 50. You're going to lose your way if you keep changing over time.
That is absolutely right, Ernie. The more you stick to those, the more you're going to have a case for each one of them, right? In my particular case, I use 4 averages, and I use the 13, the 20, the 50, and the 200. And I use them for different purposes, right? For example, the 13 and the 20 are for my shorter duration trades, maybe a day trade to a couple of days. Now I use the 50 and the 200 more for like swing trades, or trades that I'm going to be in for anywhere from a couple of weeks to a couple of months, and I will use them then. And I've gotten a feel for what to do when the price action breaches those moving averages and so on and so forth. But yeah, that's very important. Just getting to know your averages and just stick to the ones that you know. Okay.
So when we send you the welcome email to the Dorian Way, we suggest you start with the 50 and the 200 because those are the most used for the type of trading that we do. But you can, as you grow, or if you're already pretty experienced with this kind of stuff, you can do what Gustavo is doing and having some different type of moving averages and so forth.
All right, that's right. And so let's just quickly move on here, guys. So the next oscillator that we're going to look at is the MACD, the moving average convergence divergence. Okay, so what is the MACD? MACD is a trend following momentum indicator that shows the relationship between 2 moving averages of a security. Now, these moving averages are the 26 and the 12 period. How is it calculated? Well, the MACD is calculated by subtracting the 26 period EMA, exponential moving average, from the 20 period EMA. Now, the result is a line that gets plotted against a 9-period EMA called the signal line. And let's just actually take a look at this. It may seem a little complicated, but it's not. Let's just break it down here the simplest way we can. Okay. And so this is the standard. Again, this is pretty standard on any software that you're using. It's going to have the same configuration. So what we see here is we have to break this indicator down into 2 parts, or 3 parts rather. The first part is it has 2 lines, and it also has this little histogram where you see red sort of momentum and then green momentum. But when you subtract a 26 period EMA from the 12 period, the result is going to be this blue line here, okay, which is called the signal line. And then a 9-period moving average, and then this is again the creator of the MACD based on the data. He came up to the conclusion that the 9 was the best benchmark against the MACD line, created this yellow line. And so basically the premise is that the yellow or the blue line acts as the faster line, and the yellow is the slower line. So let's just go back to what we discussed about moving average crossover, right? When the faster crosses the slower one, then there's a signal. Well, same thing here in the MACD, right? When the faster, which is the blue line, crosses the slower one, which is the yellow, well, there's a signal. The histogram tells us then, or helps us confirm the or sort of the momentum of the price action, whether the momentum is generally positive or it is generally negative or flat, as we can see here in for several months. There's not much of action going on. This is an unbounded oscillator, meaning that there's really not 0 to 100 like the RSI. It could go as high as infinite or as low as infinite. It never goes that way, but it's just not bounded, okay? And the main thing that you want to look at again is just the crossover of the signal line, such as, for example, in this case, where you see that, okay, the main context is that the trend is going up, and at some point you see that the price action is converging, right? It's not really, it's really telling us that it breached, okay, the signal line breached the 9-period moving average. You see the histogram starting to get red, and then you see a huge red candle here on Apple. Well, that's 3 signals right there that, okay, maybe it is a time to start a short position. The MACD is especially useful because it is not as lagging as other moving averages, right? We're talking about depending on what moving average you're doing, it may lag the price action, but this one is pretty fast. It reacts very fast, so thus allowing you to get in much early on the movements, right? If you would have gotten short here, of course, you would have gotten a lot of this nice move to the downside, but I guess it allows you to jump in a little bit earlier than other indicators, right? And again, beware of sideways markets where there might be multiple crossovers here on the MACD line, and then the histogram or the momentum is not as robust, so you don't see a whole lot of robustness in this histogram as far as like the price action. You want to be careful there, because the opportunities are just not as big, right? It's not the same catching this drop as trying to catch this little drop right here, right? Because obviously you can be wrong more times than you can be right. And the MACD could be well used in conjunction with the RSI. Okay, now because this one is bounded, this is unbounded, it's fine. They don't overlap information quite a lot, but other oscillators such as the stochastics, it is really similar to the RSI. It has an overbought and an oversold area where Using both at the same time is kind of pointless because the information overlaps a lot, and you're not going to get much out of those two, right? But the MACD and the RSI, they can be very, as a matter of fact, it's pretty standard to use them both because it's just different information, right? One tells you, sort of like the levels, and the other one tells you a signal for momentum to get shifted. Okay, so because we're running a little bit out of time, so we're going to go into our last point here of the relative strength indicator. Okay, which is the one we were discussing earlier. And the relative strength indicator is an indicator that allows us to compare the price movement of a security with a benchmark index, a sector, or another security to indicate their correlation. And this is one of my favorite. I use it on a daily basis, especially when trading different stocks that are in different sectors. So let's clear this out for a bit. And I just look for now the relative strength indicator. And the standard configuration would be, it would be benchmarked to the SPX or the S&P 500. So basically, the red line signifies the performance of the S&P 500, and then the green line indicates the performance of this stock compared to the S&P 500. So we can quickly spot which stocks are outperforming the index or underperforming the index on a yearly basis, on a daily basis, on a weekly basis, and so on and so forth, right? For example, if we see something like Intel, right? We all know that Intel hasn't had, its best year, and it gets reflected here, right? It has widely underperformed the S&P 500 by a wide margin, and you can also compare the stocks against other stocks in its same sector or against other benchmarks, right? What we have to do is just go back to our studies. We go back to the relative strength study here. We click on the little gear, and now we can choose the correlation that we want. So for example, in the semiconductor industry, which is chip makers and all that, Intel is a huge competitor of AMD, right? So if we now benchmark it to AMD, we see that it has vastly underperformed against AMD. And the same thing could be said of if we plot now AMD, the line is flat because you're comparing AMD to AMD, right? It's just the same security, but we can also compare it to Intel or INTC. Click OK, apply, and now we see just the inverse, right? AMD has vastly outperformed Intel this year, right? And you can do this comparison, especially on market-wise sectors such as the financials, which are the strongest banks and financials, the oil, the EV stocks, which are really hot nowadays, right? You can compare NIO to Tesla to Candy to all these new autonomous vehicle, electric vehicle stocks. You can see which ones are outperforming, which ones are just with the market, and which ones are underperforming. And you most times than not, you want to stick to the stocks that are outperforming because those are the ones who are going to weather out bad macroeconomic conditions, and overall they're just best of breed, right? So you just want to stick with them. And when playing options, you can in a stock that is vastly outperforming, you can play conservatively, selling some puts and knowing that you're going to collect premium as the stock goes higher, or you can play directionally. You can play outright calls and stuff like that, right? So this is just a great tool to compare this to any security or benchmark that you want, right? You can compare it to the NASDAQ 100, so you can do multiple comparisons of a stock or an index against another index or stock, and that is everything that I have for you guys today.